Hi everyone, welcome to the first video for Accounting 202. I'll have short videos for each learning objective, and obviously we're going to start with chapter 1. And so chapter 1, one of the first things that it talks about in the textbook is, what's the difference between financial accounting and managerial. So if you're in this managerial class, you probably already had a financial accounting class. And in the finance class that I teach, financial accounting, we are looking at reporting for accounting that we're presenting to people outside of our company. So the main financial statements, your balance sheet, your income statement, your statement of stockholder equity, and your cash flow statement. So we would have prepared all of those in financial accounting courses. We would have done all the journal entries, where all that information is coming from, and then getting that onto the financials. So that is something that really is utilized a lot by people outside of your company. So maybe people looking to invest in your company, bankers or creditors who you're hoping to get a loan from, could be government agencies, things like that. With managerial accounting, the focus moves to internally within the company, that we're trying to get financial information that management needs in order to make good decisions. So it's not necessarily going to be a financial statement prepared using US GAAP. It's going to be a lot of different reports. It may not be a full-blown overview of the company. It may be very one specific thing or item that we're looking at. We also might be projecting into the future as far as things like budgeting. We're going to do a lot of analysis, like what happens if this, and this happens? Like, what would that do to our financial statements? Where would that put us financially? What would its impact be? So we're going to do lots of different analysis. So in chapter 1, we are going to look at what we would have referred to as expenses. We're going to look at a lot of different costs, and we're going to give names and descriptions to each of these costs and determine how they behave in relationship to changes in sales or production. And that's going to allow us to do some analysis in some later chapters. So the cost classifications that we're doing here in chapter 1, you will be using it throughout the semester. So make sure you feel comfortable with it. There is practice homework in every chapter, so I'll refer to that you can take a look at. There's also obviously your assignments that you're responsible for, the concept overview videos, the Learn Smarter Smart Book assignments, and then you have your homework assignments, and then finally you've got your timed quiz at the very end. So hopefully we're going to get you prepared for that with these videos and by doing some of those other earlier assignments like the COBs and the Learn Smarts and Smart Books. Anyway, okay, moving on. Sorry, that was a little bit long for that. So cost classifications, let's just get right into it. Actually, I'm going to come back to this one. Okay, we're going to deal a lot with manufacturing. Okay, so a manufacturing company, I'm moving me to get me out of the way. A manufacturing company is a company that's taking raw materials or materials and turning it into another product that they are selling. So a lot of what we do will be looking at manufacturing companies. So we've got companies like John Deere, Ford Motor Company, any number of companies that take raw materials and create a product. So what are some of the manufacturing costs that they're going to have? So we've got these 3 main costs that go into making our product. So the first one is the direct materials. So the direct materials that we need to make our product, those are materials that we can trace directly to our end product. So typically it has to be something a little bit larger, not something like super small that is insignificant. They refer to an automobile manufacturer in the textbook. So direct materials going into automobile, it could be a radio, it could be the tires, it could be the steel, the glass, the wiring. It could be whole components, like maybe we're buying the steering wheel from a supplier, or the turn signal switch. Maybe we're buying that from another supplier. So it could be things that we get from suppliers to put into our end product, not just like a raw material like steel. So it's any of those materials that go into making the product. One thing that we won't call a direct material will be something that's maybe smaller in nature, more difficult to track the cost. Like we needed some grease to put the tire onto the vehicle. So that grease, we're probably not going to say is a direct material, but the bolts and the tire would be considered a direct material. And then direct labor. So just think of the people who are hands on putting the product together. So it does have to be someone actually involved in the process of making it. Can't be a supervisor of that process. It has to be someone hands on making it. This is also referring to a person and not machinery. So there is machinery, obviously, that puts things together, but in order to be classified as direct labor, it has to be a person hands on making it. Everything else that's involved with production, all of our other costs, like we have to rent our factory, if we need a supervisor for those factory lines, if we need a janitor at the factory, um, security at the factory, depreciation on factory equipment, maintenance on factory equipment, those are all considered part of our product costs, our manufacturing costs, but they're not materials, they're not labor. So we have this kind of catch all category called manufacturing overhead. So what fits in there? Indirect materials like the grease that I was talking about, indirect labor like a supervisor at the factory or a janitor at the factory. So these are all people that are involved with production but aren't hands on making it. And then here are some other examples of manufacturing overhead. So basically, any of your factory costs that don't fit into materials and don't fit into labor, we're going to put into this category. So those are all of your manufacturing costs: direct materials, direct labor, manufacturing overhead. They also give you some other terms. Prime costs of making your product would just be the direct costs of the direct materials, direct labor. If you hear the term conversion cost, that's referring to the cost to convert the materials to the end product. So that's just direct labor and overhead. Let me go back to, oops, the slides that I skipped real fast. This direct cost and indirect costs. So more cost classifications for us. Oh dear. There we go. Okay, so direct costs, those would be your direct materials, your direct labor. Indirect costs would be referring to manufacturing overhead. So just a few more pieces of cost classifications. Sorry, I'm going to flip ahead here, get us back on track. And then outside of your manufacturing costs, you're going to have these non-manufacturing costs. So non-manufacturing costs, a lot of times we can lump those into two categories: selling costs and administrative costs. Selling costs would be, your salespeople salaries, all the equipment, whether that's like a vehicle for sales calls or a computer that's for your salespeople, advertising costs, shipping things to your customers is considered as selling costs. And then administrative costs would be all of your other overhead costs that aren't part of production. So your HR people, your accounting people, your CEO, your CFO, salaries, equipment, office space, depreciation on their equipment, all of that would fall under administrative costs. Okay. And then finally, where do these costs go on our financial statements? So instead of using the terminology manufacturing and non-manufacturing costs, we're going to flip over and call it product costs, which are your manufacturing costs, and period costs, which would be the non-manufacturing costs. So where the heck do these go? So direct materials, direct labor, manufacturing overhead, they're called product costs. They're going to go into an inventory account. So as we're creating our product, it's going to go into an inventory account, one of these three accounts. And we don't need to get in the specifics of it yet. So let's just say all of those product costs go into an inventory account. Inventory is an asset. So it's a resource of the company. It stays as an asset until we sell it. So once we sell our inventory, it's then going to move into cost of goods sold, which is an expense account. So when it's sitting here in inventory, it's an asset and it goes on the balance sheet. Once we sell it, we're going to show that as an expense on our income statement. So let's say we're John Deere and we've made this tractor. We have this tractor, this asset sitting in our inventory on our balance sheet. Let's say it cost us $100,000 to make it. We sell it for $200,000. It's a really nice tractor. So cost of goods sold, we're going to move that 100,000 what it cost us to an expense account called cost of goods sold, which goes on the income statement. At the same time, we'll also recognize that we have revenue of 200,000, but you have to show the expense of what you had to make it. So in this example, 100,000. So you're going to have an expense along with your revenue. So that is how we handle product costs. Period costs, like your non-manufacturing costs, selling and administrative, we just record those as expenses when we have them. So advertising expense, paying your HR people's salaries, depreciation on office equipment in your administrative offices. Once you've got the expense, you just show it in the appropriate expense account. It goes directly onto the income statement as an expense. And take a look at this one, see what you think. So they want to know which would be considered period rather than product. And going down the list, manufacturing equipment depreciation. So depreciation on equipment in our factory, because it's in the factory, that's going to make it a product cost. It's going to go into manufacturing overhead. The next one, property taxes on corporate headquarters, because it's corporate headquarters. That's going to be an administrative cost, and that would be in your period costs or your non-manufacturing costs. So that's a winner. Direct material costs, remember that's part of your manufacturing and product costs, so not that one. Electrical costs to light the production facility. So because it's for the production facility, that's going to be a product cost or manufacturing costs, and that would be not a period cost. And then sales commissions would be part of your period or non-manufacturing costs. Okay, in your practice homework, there are numerous exercises that go over cost classifications. There's an exercise 1-2, exercise 1-3. You've got several in your homework where you're doing this as well. Just remember in your homework that you do have the check my work. So after you pick something, be sure to hit that check my work and see that you have things correct and make changes as you need to. But definitely review some things in the practice homework and let me know if you have questions. And that is all for this time. See you later.